I have some amazing, talented people on the panel today, and I would love for them to introduce themselves. Dominique, let's start with you.
Sure. Hi. Happy to be here. So my name is Dominique Aubry. I'm the founder of Aubry. We are a celebrity-driven shopping app leveraging computer vision, augmented reality, and AI to help you find perfect fit and match. And I have a long background in tech, but was with a Mass Challenge finalist 2019. Worked with the Techstars company in 2014 in New York. I'm a mentor for Techstars, Harvard iLab, Mass Challenge, and a bunch of other accelerators. And I'm happy to be here.
Awesome. Ian?
Hey guys, my name's Ian. I founded the Chicken and Rice Guys. We have a food truck business. This is my food truck behind me. We have 4 restaurants and 6 food trucks up in Boston. I actually opened a store in Houston that closed during the pandemic, but now I actually moved here because even though the restaurant's closed, I just really love Houston. It's such a great city. And now I'm doing a new business called Operation Entrepreneurship. And I'm applying my entrepreneurial lessons to nonprofits and organizations and helping them run more innovatively.
Awesome, Ian. Odie?
Hi, everyone. Good to be here. My company is called Sensitech. We're a startup here in Houston. And what we do is we focus with IoT products and software solutions to monitor structural health of concrete structures. We've been doing this since 2016, really, after I graduated from U of H. Yeah, so I've been a part of multiple accelerators. I've raised a couple money as well. So yeah, thanks for having me.
Yeah, awesome. I love that you mentioned money, Odie, because that's exactly what we're talking about today.
Yeah.
All of it. So today we're talking about financing your $1 million idea. And as we can tell, you guys have all started incredible businesses and operations, and would love to dig more into that too, mostly on how you went about raising the money or getting the capital to establish your companies and also develop your companies too. So I'm curious to know from each of you guys, what was your main source of financing your business to start?
Do you pick on anyone or?
Yeah, go ahead, Odie.
Okay. All right. So we started off with mostly like friends and family initially. I mean, I don't have a background with a lot of rich uncles or aunts, but it's just really the network that I grew as part of being at U of H when I was there at the Wolf Center for Entrepreneurship program. And then I got into accelerator programs. So we started to figure out there's some accelerators that provide you some pre-seed funding. One of ours was Techstars. They gave us about $120,000 for a pre-seed. That was a really very, very first outside investment that we gotten. But before that, we started doing business plan competitions. And that was free money. We were really good at pitching our product, and we were really good at answering questions about our product to investors. And during these competitions, they would give out $10,000, $20,000, $30,000 just because you have a really good pitch and a really good product. So that was basically free money. So there's other opportunities too, as far as grants and things like that you can be a part of too. But that's kind of how I started.
Awesome. Ian?
I'm not as smart as Odie. I don't think I would win though, so it's not free money for me. But yeah, just like Odie, I bootstrapped my way when I first started. I actually didn't have enough savings to really get going, so I talked to a couple other folks that became my initial partners, and we all put in initially just $5,000 each. And the rest we kind of bootstrapped with the revenue. We put some on credit cards. I got a small loan from my mom. And the first food truck we bought was $20,000. So we were able to afford that. And then we needed about another $20,000 on top of that. And that's where like the credit cards came in and then our initial revenue. And from there, we've just bootstrapped the business to where it is today. We have 4 restaurants and 6 food trucks. It's really hard to bootstrap, and I don't know if I would do it again. I probably would have raised some money, but you do get to maintain control, which is nice.
Awesome. And Dominique?
And sure. So yeah, I kind of did a mix of all 3, I guess. And so won some competitions, had my own kind of little savings, about $10,000 I put into the business, had a small loan from my family, and then also went and raised kind of like through angels. So, we're really early. We're like pre-seed, pre-revenue. So we kind of, got our way up to about 50K kind of starting from there. But I think what they both just said, what Ian and Odie just said, is like spot on, because I think something I didn't understand when I first started. I'm non-technical and I'm building a technical company. The cost of building tech as well as marketing is like just really expensive. And so I think people talk about how do you raise money, but I think it's like, what's the smallest lift, how much, the least amount you can spend to get the most validation and the most kind of revenue in is like is way more important than the raise, because without that, you can't really get the raise either, unless your tech really requires that kind of investment. So I thought that was just like spot on comment to note that they were both revenue focused. Yeah.
Awesome. So Dominique, did you raise capital?
You're on mute.
Oh, you're on mute. We'd love to hear you
Sorry.
though.
Yeah, I raised about 35K, and then I won a pitch competition, and I had my own money. And so that was all through angels. And so that, and then, and I'm still raising right now up to 250K. So we're in the process right now. But those initial checks came from relationships. And I think to the point of ecosystem, you're spending a lot of time building that network and ecosystem to be able to then do the ask. And so those people that give you those early checks, they are really investing in you, not even your business, because it's so risky at that point. And I don't want to jump ahead of what everyone else is saying, but I think something that maybe they can chime in on and note is the issue of like, if you're going to go after and raising capital, you do have a boss. They're in a sense, they're investing in you and the company, and they're on the board, depending on who they are. But they are going to require certain things of you. And so for most folks who don't have rich uncles and aunts, when you're going after angel money or even VC money that's now scouting because the area has evolved or whatever, they're looking for traction and outcomes that you might not have at your stage when a uncle would have given you 25K, but this uncle doesn't know you. So that requirement for 25K is a lot higher for what you have to produce to prove that out. So I just think I don't know, I just focus on the revenue from what everyone's saying. And I think even from what I raised, I still think, I should have focused on the revenue earlier. I think it would have still been a better idea.
Yeah, because also you want to think about whenever you have revenue, or at least generating some revenue, money becomes cheaper, meaning they take less chunk of your company when you're doing an investment, either from a safe note to a convertible note or even equity. You want to be able to prove your concept works. And in some cases, you don't even need their money, but you need their money to scale and to increase your business. So money is always cheaper once you have numbers to prove your valuation.
Okay, awesome. And so for someone starting out, how do you even know that you're ready to raise money? Like where do you start? Like Dominique, I know you mentioned network, but if I'm fresh, brand new, and I have this idea and I know it's going to need some capital, what are some of the first things I need to do to get there? How do I figure out how much I need?
I have strong thoughts on that, but someone else can go first.
Yeah, Ian, let's hear your journey, because I know you bootstrapped.
Yeah. I'm gonna keep my talk to what I know, which is in the non-tech, non-raise world. So I would say that actually even before raising your money for your idea, you can actually do a lot of testing before with not a lot of money. So for us, when we had the idea of bringing chicken and rice guys, the dish from New York to Boston, because there was no dish like that. That was our only idea. And we tested it by every day coming back from work and testing out recipes on how to make that chicken and rice. And really, I mean, that was like maybe $100 to just test that out, every night we came back from work. So that's a way to start like testing out ideas. And then when you get a good one, that's when you start to invest the big chunk of money. And that's what we did, right? So we tested out the idea. We spent probably under $1,000. And then when we knew we had a good product, that's when we, got that money together. So that's a good way to, test out different ideas. Start small.
Yeah. So validate your core offering and then start to build and scale from there.
Yeah. If you're in the non-tech world, in the tech world, totally different, but yeah.
Yeah. So from our tech founders, how is that different from the bootstrap route?
I can answer a little bit of that. What we did is we actually went and actually saw, what is the actual market currently doing today and how much they're spending on that and what it requires to be able to perform that type of product or service. So, we have some competition in our sector. So we went to see, okay, what are they selling it for and what potentially could they be, manufacturing it or making it for? And so that kind of gave us a baseline of where we believe we need our capital investment in and if we need some investment. So what we did is, for us to create something like that, we like Ian said, is to really make a prototype. I mean, you do your prototype and, you spend as little money as possible just to prove the concept and then move on from there. But at the end of the day, you got to do your homework first to really understand, okay, how much do I really need to do or to spend to make this work? So yeah, I'm sure Dominique has a lot more to that.
I disagree with both of you. I'm just like, yeah, sounds about right. I think in reality, I mean, I think the thing that, again, I actually, this is a great panel because you have different perspectives, because what you see is the starting of every business is kind of the same. And I think for most underrepresented or whatever founders, like you're building a small business before you get to the investment side. I mean, the approach is relatively similar, unless you're in biotech or you're some industry that the cost of entry is so high that you have to raise money to execute. I think what you brought up is important, because if you check the market size, you're able to say, hey, actually, can I compete? Can I build the thing with the money that I have to produce a product that's competitive in the market? So I think that's a good kind of way to kind of check on that. I think the other thing is just I can speak for me as particularly just I don't want to say a female founder, but as I think of a female, I think a lot of females may feel something similar, which is that we're not really taught about money growing up. And so we have this kind of fear of financial management that we don't kind of talk about. We can project manage, we can operations all day, we can even do sales, we're super passionate. But I think sometimes we have a gap in understanding the financial model and like how to manage our burn rate and how to like deal with all those things that really impact the business opportunity. And so not to get into details of like how to financially do all that stuff, but I think just addressing that fear head on and knowing that you can learn anything, because the easiest thing to learn in entrepreneurship is the business stuff, because you can buy a book on it. What you can't learn is your risk appetite, your talent, your personal interest, your passion, like that comes from you naturally, but you can kind of figure out the other stuff. It's, there's business schools around that do all this all day. So I think from that perspective, from the financial, like how to kind of think about the money is just like not be afraid to dig into the money, because you're going to need to anyway to scale. And so I think just what you're saying, I just kind of agree with both of them on how to start, but understand how much it costs and how long you can do it at that cost before you go broke. I mean, basic math, I think will get you there on that. Yeah. And I think that's what we did. And when we first started, we were selling yoga pants in Macy's. That was how we started before we became a tech company. And I bought so much freaking product. And, a decade ago, I used to sell scarves. I used to sell them at flea markets in Philadelphia, I used to import them and sell. And I bought tons of freaking scarves. And I was like, you know what? It's been a decade, Dom. Like, learn the difference. Like, why are you overbuying the product? Right. And it was just really understanding, like, I had not addressed some of my lack of understanding about the financial modeling that I was kind of afraid to dig into, that I should have dug into, that would have shifted how I would have managed my money and given me a longer roadmap, a runway of cash to use to build the business and test. So.
Yeah, definitely a learning curve for sure. I think for founders, first-time founders especially. So I heard different funding routes, from the bootstrap to going accelerators like Mash Challenge, and then also raising money from investors. So Ian, I would love to hear about pros and cons you've experienced from bootstrapping. Odie, I'd love to hear about the investor side. And then Dominique, I'd love to hear about your experience working with accelerators and pros and
Yeah,
cons for each.
yeah, I just want to add, actually bootstrapping is the most common route. I think maybe less than 1% of businesses are funded by VCs. So it's actually pretty common and pretty doable. And um, at the time when I raised that savings, raised my own fund, which was my savings, I was working like a $17 an hour job, right? So I was able to save that amount. And the reason why I bring that up is anybody can find a $17 an hour job and save up if they do the right things financially to start a business, right? Um, so, it's very doable, very doable. And what I would say with the pros and cons is I did take on some investors later, and uh, I can't speak too much, I guess, about the pros and cons because I don't have like a big fund behind me. But I would say it was kind of annoying in the beginning having investors. Um, I went from having to just like talk to my partners about things to having to talk to like 2 other people. So it's like I had to check in with 5 people before getting anything done. So it's kind of annoying. But actually, I got into a cadence with them and I got to know them a little bit more and what they wanted and what they needed. And it became easier. And I think if I were ever to do like a big business again, I would definitely raise money at this point.
Odie.
Yeah. Yeah, you hit it right on the nail head, Ian, because we bootstrapped a little bit as well. And we don't have a big VC fund backing us neither. We're still bootstrapping in our operations right now, right? So it's not like we got millions of dollars in the bank and we're spending it on we have awesome salaries. That's not the case. So but I have invested in or I have some VCs invested in our company. But I think it's a long process. They say usually it takes maybe 6 to 9 months to even build that relationship with that investor, and really at the end of the day have them sign the check over to you. I mean, it's a grind, and you gotta you got to target at least minimum 100 investors just to probably get 1 or 2 interested. I mean, that's just kind of how the business works. For us, that was really the hard thing to do when going and looking for VC funding or outside investment from other either angels or things like that. So the pros is you got some nice backing. You got people with money that can back you up in case something happens or whatever the case may be. And then also follow-on funding becomes a lot easier because you have people already that you've established those relationships with, and it doesn't take as much time raising a Series A or even a seed round if that's the case. And then also, most of those people that are in those type of funds have connections that can really scale your business up pretty quick, which becomes more lucrative as an investment for other investors to jump in. So I think finding the right investor that can open those types of doors for you is all based on what you want out of it and your research that you bring on to that fundraising round that you're opening. So yeah, that's kind of my perspective on it. There's a lot more to it. I know. I mean, we don't have much time, but that's kind of the gist of it.
Right. So Dominique, can you talk a little bit more about why someone would want to raise money? I know you mentioned like biotech, but let's say we're not biotech or a medical device. Why would someone want to raise money from a traditional investor or a dilutive route?
Well, usually, I mean, it is to, to grow, in general, or to get an MVP out there. I think it's hard to raise money if you have no MVP. Because the money you need is to build the product, like the initial version, and that can be hard to validate because someone has to really know you and trust you. And I also think the market's the right market and all the different pathways. So you're doing a lot of what I consider to be like an academic exercise to kind of prove out a thesis before you build it to get someone to give you money. So I think the sooner you can find a product that you can build something that shows something, the better you're going to be in general and across all accelerators of different stages. I mean, they're good access points, they're good entry points. They give you tons of network and some will give you cash. If you already have a business, it could be slightly distracting because you have all this programmatic stuff that happens in accelerators, but the network could be worth it. And again, the funding and the follow-on funding post-accelerator could be really worth it. But I think, like, just to go back to like what both of the guys said, like, it's like, figure out what you can do with the cash you have, or figure out how much cash you need to get something first off. You know, financing is so sexy and like the language about raising that we forget that we're sometimes like building actual real businesses behind that have to run regardless of the financing or the accelerator you get into. And so I think focusing on what's the like, what am I going to build is like the more important thing, because once you build it, all the other things become much more easy to access, in fact, versus trying to build a thing for the accelerator or for the VC. It's like, build a thing and then the right people will kind of come to you. And there's a really, you have to work some things out there to finesse that, but that's kind of really what it looks like. So if anyone wants to do an accelerator, I think they're good if you need to learn a lot of fundamental business practice. But just know if you're trying to go to one that's giving you capital, very few, like I think Visible Hands is a new one that just recently came out. Very few are going to give you money with no product and no ideation for most types of things people build. Give or take. So
yes, so it sounds like you have to have something going, you know, so the ball rolling for the capital to be more of a reality for you. So Odie, what is something that you didn't expect along your journey of raising money that happened, and how did you manage it?
Oh, that's a good question. Something that I didn't expect was the time that it takes and the repetitiveness of raising money and answering really difficult questions, and maybe some questions you didn't even think of that kind of like, I should have thought of that before I even try to raise money, right? So there are some things that will catch you, you know, that will blindside you on some of these things, but mostly though, it's really about, you know, making sure you have a really solid business model, making sure that, you know, if you have customers, maybe some of those customers will vouch for you and actually help you raise money as well. You know, those are just some of the things, but it takes so much time and effort to get it going when you're trying to raise money outside, especially VC funding or anything like that. So along the route, I would just go randomly to a competition and raise, you know, 30K in one competition, right? So I didn't have to waste too much time doing this and stuff like that. And one of the things too is also it took a lot of time away from my business. So, you know, I'm like the guy that does a lot of stuff around here. So I do from engineering to mechanical to, you know, operations and financials and everything really. So when you're raising money, you kind of get away from those things and you forget about sales, or you forget about a customer, or forget about something like that. And that you need to plan out ahead of time before you really want to go along this road.
Yeah, I often hear that raising money is like a full-time job from a lot of founders.
It's
So
full-time plus overtime.
yeah, that's a lot. That's a lot when you're starting a business.
Yeah.
And Ian, you have had a remarkable journey of starting to raise your own fund and then eventually bring on investors. How did you keep going? I imagine you had some hard times. How did you like keep the motivation and you know, stick to the long-term vision that you have for your business?
Well, I've been doing this for 10 years now. And actually, the answer was I wasn't that passionate about it. And I ended up moving on. And I think that sometimes, even though we were successful, that doesn't mean this is the job that I want to be doing for the rest of my life. And I think I realized that I actually I went on like a annual retreat. Every year I go out and I like listen to an Audible. And I think I listened to Oprah's book it's called The Path Made Clear. And it's about like finding ways to feel in the flow, which is like, for flow is like when you feel great, when you're working and it doesn't feel like work. And I guess that book resonated with me, and I felt like, yeah, I'm successful in some ways, but I'm not feeling in the flow at work. I'm not loving being in the food business. So that kind of got me to do my new business, operation entrepreneurship, which is what I love doing, which is combining helping others with the entrepreneurship education knowledge I learned.
Awesome. It's amazing. And Dominique, what do you wish, if anything, you did differently? And what advice would you have to students starting out that are wanting to build their savings or take that first step in financing their $1 million idea?
I mean, I don't,
You're like so much.
like we pivoted 4 times. You know, we were selling pants, then we were making pants, then we were baking tech, and then we had to tweak the tech. And so that was a journey. It's been a 2-year journey. So I think I just agree with Ian so much on like find something that you care about, because at every transition I have to go like, do I care about this? You know, like, does this really move? Because it is a 5, 10, 15-year journey, like, you know, so it's, you got to care. So I think like for the long haul. So I think a lot of times the ideas you fall in love with in the beginning are not what they come out to be on the other side. And so you have to really kind of dig deep to understand what the alignment is to keep you motivated in the business. I think that's really important. If I could give myself advice, if I give myself 3 pieces of advice. One is find a technical founder, find your team as soon as you can, in the sense that find some people that you like to work with. How you negotiate the relationships can happen over time, but try to think about who you like to work with and what value they bring, and try to get people on board, because the more you have to pay for the things that you can't find, the more expensive it is to build your business. So that's probably like the number 1 thing I would think about. It's always going to cost you more money than you think. So just know you're going to run out of money faster than you plan. So you can't really solve for that, but knowing that is a little bit easier to manage the emotional experience of it. Just because I think that happens to every single person. So I would kind of make sure not to kind of just manage your money, but understand that. And probably the last thing I think I personally kind of, if I could do it differently, I think I would not get so caught up in the hype of the startup stuff. And I think I would spend more time trying to solve my customer's problem versus going to every pitch event or going to every networking event or all that different stuff that you do really early on, because you want to be part of the buzz and you can say I'm a founder and it's exciting. But the reality is you got to look at your milestones. If you're not hitting your metrics, you're not building anything. And so you're not really doing the thing you said you were trying to do. So I think that if you want to do the thing you want to do, you got to focus in. And actually, in a lot of ways, that stuff is noise, and getting better. You know, that book, The Signal and the Noise, is the same thing. It's like getting better at determining what the signal is in the noise will help you save time and help you focus. And you won't be building things kind of for optics, but really for the business. And I think that's something you get caught up in and you don't really sometimes realize when you're in that space for a long time. So those are some insights over the years I've had.
Yeah, I resonate with that. The startup world, it's like its own world. It's kind of hard to stay focused on your
Fail
mission.
fast, you know, whatever, raise money, like don't spend your own cash, like raising $1 million is like raising 10 million. Like, no, it's not. It's like, it's all that stuff isn't, you know, and maybe find mentors, and not just mentors, but know that you're evolving. So your mentors need to evolve with you. And one mentor you have might not be right for you at different stages of the business. So you have to always be cultivating the network of people to support you, because you are not an island. And to build a business, you need a community. So maybe that's something also.
Yeah. I totally agree. There's like people that do things for Instagram, and there's like Instagram CEOs too that just like do things to post things on Instagram. It's totally true. Well
and sometimes you need Instagram, but you just need to like the difference, you know, it's like you only know the difference as the founder, like your intention, like you only know why you're doing it. So you got to check yourself, because no one externally will know the difference really until you know the difference, right? And so yeah, it can be. I remember applying for salary, and they were like, I said, well, I could think about doing that, and they're like, no, don't do that if it's not for the business. Like, we don't need you to do that. And it was just kind of that moment of like, I hadn't done enough work to kind of ground myself in what had to be true for the business it was like kind of skewing how I thought about the build of what I was doing, right? For the capital. And it's like, it's not about the capital. If you build the thing, the capital in many cases will come as you align more closely, as that merger kind of happens and more organically, it will kind of come together. But to your point, only 1% of people raise VC, so most of us will not. So I think it's also real to say, like, build something that can pay you, because really you're the one who needs to get paid to do this thing to live. And that's more important than raising capital in the beginning.
Yeah, so many gems. So we have some questions in the Q&A. So let's get to those. So we had someone ask, how do you figure out the perfect price? Dun, 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 price question. I'm going to hand it off to Odie. Let's hear what you have to say with that.
I'm guessing price of the product. So, I mean, if you have competition in the market, it's pretty easy. I mean, you look at that competition, you see what they're selling their product for, and you kind of do your own model and figure out, okay, what am I bringing in value besides what's already in the market? And do I either need to be cheaper or more expensive, but add more value in the case? We were in that same position where we were bringing in a product and to the market, and we thought that we could be more expensive. We were trying to sell our product for like $200, and the market's used to buying it at $100, right? So we had to go back and figure out, okay, how can we build a cheaper product, and what other value we can do to compete with this price point that the market's already used to. So we figured that out, and we're beating our competition. So that's just kind of something that where you would start off on.
Okay, awesome. And then on the non-technical side, Ian, can you weigh in on that?
Yeah, there's a lot of information online about how you should price your products in your industry. So in the food industry, you can actually Google, like, how should I price my product? And the way that most food places price their product is you should spend 30% on the food costs, 30% on the wages, 10% on rent, 10% on miscellaneous expenses, and then you probably have about 20% profit at the end. Those are like ranges, but there's actually websites where you can go down to different industries and look exactly what the profit margins are by industry.
Thank you. So being young, how do you get investors to take you seriously? Oh, that's a good question. Dominique?
I want to be like, you don't.
That's the trick.
Well, and not because you can't be smart and talented, but because you're young and they're old. It's like, think about how your parents taught you. Like, they just know things you don't know. So no matter how much you know, you won't know what they know, right? So, in that way. But to take you seriously, so I think there's a couple things. You have to look at so what they're not betting on. So they understand that you can do things cheaply because you're young. If you can live on ramen, you can live at your parents' house. They understand that there's some cost savings that could happen because you can take more risks because you're younger. That's cool. And your excitement and passion and energy is just proving out that point. What it does not answer is everything else about the business that needs to be solved for. If you're doing a SaaS business for ad agencies, but you've never worked in an ad agency, they're like, you're going to have a problem, getting into that industry and getting into that world. So your enthusiasm does not, I guess it does not overcome the real business challenges that have to occur. So they're not taking you seriously. They just see the blind spots that you think kind of energy is going to get you through. And so what I recommend there is just looking at your business more pragmatically, going to mentors and saying, listen, if I wasn't me and I was someone else, what are things I need to have in place? Because you probably need more advisors, more strategic partners, maybe some people on your team who are a little bit older who have access to those networks, who have done the thing you're saying you want to do. So it's just about building out the right team, most likely, and infrastructure, because it's not that they don't take you seriously. They just understand in the business that they are in, what your capacity is. I think something that people don't really think about is that VCs and people that have money to give you, it's a whole integrated network. Part of the value of the VC is not just the cash, it's who they know, it's all their relationships and all their partnerships. You, at whatever young age you are, don't have those, right? So they see things from a lens. It's not they don't believe in you or don't think you're serious, but they just have they have a 30,000 foot view to this industry that you don't have. So just know that it might not be that they don't take you seriously, but they just know that there's gaps. And if you identify that that's real, then they'll respect you more for how you're going to go approach the business, because you're dealing with reality, and that's how you build a business, right? So I think that's probably what I'd say.
I think the best way also too is you prove it with customers. I mean, simple as that. You got sales and you're killing it. That's, they can't really challenge you on that. I mean, there's people buying your product, and you can scale it up from there.
Yep. Exactly. Sales never lie. And what are some strategies for selling a pitch when your idea includes selling or providing a service? Anyone can take this one.
So I can jump in really quick. Oh, go ahead.
No, I was just saying I can't find that question.
Oh, I clicked on it, so it might have disappeared.
Can you repeat it?
Yes. What are some strategies for selling a pitch when your idea includes providing a service?
Yeah, I'm not a good person to answer that one, so I'll leave it to somebody.
I would say don't. I mean, so what we do, so not like don't, everything, so anything is possible and everything is possible. So I'm never here to say don't do something you want to do, but sometimes the startup world has been bleeding into every other sector. And so we think the way that we build startups is the way you build everything. And sometimes it might not be. So I was working with a nonprofit the other day, and they were going through a pitch process. And the reality is that the pitch that they were building was really an intellectual academic process for them to understand their business more deeply, but they weren't going to raise money on it in a sense. They were too early. There's a whole bunch of things, and they were going to probably go after a grant, and they would need some of that information, but not all of it. So I think the same thing is kind of true in this case. The economics have to be in your favor. When you're talking about a service or a product-based business, you usually, if you can raise money, you would raise later on when you have more traction and more growth, to Odie's point and to Ian's point. Like, you have money in the bank, you're showing you have sales and customers, people are giving you money for growth, not validation. But I would also look at models. Like, I would look at, well, how did McKinsey build McKinsey or Bain or Deloitte? Because service-based businesses, consulting services, even if it's like a home decorating service-based business, they have their own different models, and they go about the fundraising and financing process slightly differently. So every industry has its own peculiarity or specialities in a sense. So I would look at that. The other thing to note, if it's a service-based, just in there for clarification of language, if you're talking about pitching your deck, if you're talking about just a sales pitch, then that's like just talk to some salespeople or read a sales book, and you can learn how to like do more sales from a pitching perspective. From a pitch deck perspective, most service-based businesses have a technical component that reduces the cost of doing business. So you probably I would think you need to have that to go raise money, but again, not 100% everything is possible. So yeah.
Awesome. Okay. Dang, so many gems today. This has been an amazing panel. I want to spend the last minute we have for you guys just to say one piece of advice that you want to keep with all of the students from today. Not all at once, please.
I'll start. One piece of advice is really understand what you're trying to build and why you're building it. Many people get lost into thinking that they have such a cool idea because their mom says it's awesome, their friends say I like it, but really you got to understand what market you're getting into and figuring out what price point you want to sell it at, and overall, if people are really going to buy it. I mean, that's really the simplest it can get, because if you build a product nobody wants to buy, you're wasting your time. So always do your market research, and customer interviews is always the best way to approach it. So if you're building a consumer product, find 1,000 consumers that you think you can interview and ask them, do you like this idea? Should I build it? How much would you pay for it? And vice versa with technical products or services.
Awesome. Ian?
I would say develop a thick skin. I started 3 businesses before Chicken and Rice Guys, and people started making fun of me. Oh, look at Ian start another business. Oh, that's cute. No one's gonna believe in you, and you have to kind of believe in yourself. And there's so much knowledge, there's so much learning, there's so much networking opportunities out there. But at the end of the day, you kind of just gotta overcome your fears, overcome whatever you're gotta overcome, and just do it.
Awesome. And Dominique?
You have more time than you think. So maybe I'd say, go slow to go fast. Yeah, take your time. I think what Ian talked about, finding that early product validation, like go slow, go cheap to build a product and see if you can sell it before trying to kind of, take on the whole world. So I think when you're young, you feel there's like a urgency and then there's a panic and you're not doing it, you're not succeeding, and there's all this noise. And Lean Startup's a great book as well for that. There's the whole Sprint's a good book for that. There's a couple others. So I would just say go slower than you, I would say go slow. You have time, use your money wisely. And once you hit, you'll know, and then you can invest the money. I think what Ian and Odie both said were like spot on in terms of like any successful business basically did the same thing. They kind of were smart about their early capital in. They got to a place where they knew they could grow and they would have something that would drive revenue. And that was really what helped them succeed. So I think that to me is like the life lesson of all lessons. And then also find your team, and it's okay to have interesting and weird negotiations and relationships in the beginning, because it'll be cheaper than outsourcing it. And you don't have to be perfect. You just have to do it. Right. So, yeah.
Awesome. Dominique, Ian, Odie, thank you so much for being here. I'm sure everyone took a lot away from today and a lot of lessons. So thank you guys again.
Thank you.
Hey guys.
Thanks for having me.
Great work. We wanted to thank you all. I think Ian, did you have some last words?
Oh, no, I was just going to say thank you. And my email's here if anyone has any questions afterwards.
Yes, and we also put everyone's LinkedIn in the cohort packet that we sent out to all the students, so you can go ahead and add everyone on LinkedIn as well. Thank you guys so much. I did want to say a message for the founders in the hackathon that will be returning to the meeting link in around 10 minutes. So go ahead and have a quick break, and then we'll be rejoining in around 10 minutes. But thank you all, panelists. Y'all have done so great answering these questions. And thank you, Ayo, for your time and hosting this session as well.